Dr. Faber, good to talk to you this morning.
It's my pleasure.
We have some news on the U.S. stock market. Stocks rallying this morning. They're optimistic about a solution for the debt crisis in Europe. Politicians meeting for yet another summit. Do you think anything concrete is going to come out of all this?
Yes. What the summit will essentially do is address the symptoms of the problems, and the problems will be postponed, and there will be monetization. That there's no question about this, and that was always my view for not being overly bearish about equities, because I'm aware the governments, through fiscal and monetary policies, they're going to monetize. There's no question about it.
Okay, so just like the U.S., the approach is to monetize the debt. We know that's going to postpone the problem. It's going to kick the can down the road. But there still don't seem to be any cohesive solutions here.
Correct. The solution really was proposed by the BIS in a paper, and that would be to reduce the debt level very substantially. Debt to GDP. But this isn't really on the agenda. And, like in the U.S., when they talk about deficit reductions, they never happen this year, but they happen in 5 or 10 years' time. And so it's continuously postponed, and it never happens. So my view is that they can postpone the problem and markets may rally for a while. I doubt they will make new highs, and I doubt that it will really benefit the typical household and the lower income group recipients. But it will do some good for stock prices, and they'll overshoot again, and then there will be another decline. I mean, I just happen to think we live in a very volatile time.
Is it more volatile now than it has been in the past? You've been around markets for a while.
Well, this year we had more 9-to-1 upside days in terms of volumes of advancing stocks, and 9-to-1 downside days in terms of stocks going down, 9-to-1 compared to stocks going up. Then for 20 years in the 60s or so. So yes, we are in extremely volatile times, and exactly why it happens is probably not one single factor, but a number of factors. The interventions by the government and artificially low interest rates, where essentially, let's say you have been a saver all your life and you had your money on deposit with the bank, and the bank paid you interest, and on that you're retired, or finance part of your retirement on the interest income, and now you have zero interest rate. So essentially the central banks force people to speculate.
Mark, in addition to the speculative angle that's going on in the markets, you've mentioned a couple of times in the past, high frequency trading. How does that affect the markets? We know it causes a lot of day-to-day volatility.
Well, I suppose that 99% of high frequency trading programs are essentially momentum players. In other words, when prices start to move up in an asset class or in a stock or in a sector or for the stock market, the computer model says buy. And then they all buy, and it pushes up prices. And when, for one reason or another, the market turns and the models say sell, they all sell basically at the same time. That's why you have very high volatility. That's my view.
Mark, do you think we could see another flash crash, or is this thing kind of self-regulating?
Well, I don't think it's regulated, and I think my concern is not so much about the stock market going down one day by 500 points. I mean, a real crash would be on October 19th, 1987, when the market dropped by 21% in one day. My concern is more, we have essentially an economic system where the financial sector has grown disproportionately large to the real economy. So in other words, The economy may be a square mile, and on top of that, you pile up derivatives and all kinds of instruments that are thousands of square miles. And one day, this whole derivatives bubble, in my opinion, will global.
Now let's talk about markets generally. You're on record as saying you prefer equities to things like bonds and cash for the next little while. What's your feeling about markets going forward in the next couple of years?
Well, my sense is that I wished I could be very bullish, and I wished I could be very bearish. But I can't be very bullish because nothing has changed. We have incredible corruption in the system. We have essentially a Wall Street dominance of lots of sectors of the economy and banking dominance, where the banks go to government officials and say, oh, if we're not bailed out, the whole world will collapse, and the politicians who are clueless, they believe that, when actually the easier solution would be to ring-fence the local depositors, the domestic depositors, and let the rest go bust. The world wouldn't suffer if the derivatives market would shrink by 90%. Believe me, the worker in an automobile plant, he wouldn't feel it. But, of course, the bankers would feel it, and the financial sector would feel it. They would have to lay off a very large number of people, and the profits would tumble. So basically, that is my concern.
We're talking to Marc Faber from the Gloom, Boom, and Doom Report. And Mark, one of the things finally catching our attention on the world stage after all the news out of Europe and the U.S. is China. China's currency down against the dollar for the fourth straight session. You've mentioned that there's a huge capital flight out of China. Will that accelerate if China starts easing?
Well, I think it's very large, and it's likely to accelerate because there's a lot of dishonest money in China, and it's looking for, say, what they would consider a safe haven. And the Chinese and every government in the world, if they are faced with economic weakness, they're going to ease. And so I'm not that negative about the US dollar. I mean, there's no reason to be optimistic about the US dollar. But relative to the others, I think the dollar may hold. And as you know, this year, and this is something I have maintained for now over 12 months, I think the U.S. market has significantly outperformed emerging economies' stock markets, and I think that may very well continue to be the case, because we have essentially not created through money printing in the U.S. a bubble in the U.S., but we've created bubbles in emerging economies, and we've created very high inflation in emerging economies. And so this bubble in emerging economies may burst. Now, some people will say, well, there will be a soft landing and so forth. Maybe that is the case. But I would consider the outcome, if there really was a bubble in China, and if there is a bust in China, what the implications are on the world.
Mark, if the economy does slow down, soft landing or not, it's obviously going to have a huge impact on places like Canada, where we export a whole lot of resources, and places like Australia as well, right?
No question. No doubt.
I saw a great quote here from a couple of weeks back. You said the Chinese invented paper. They know how to print money, and they're going to do it with a vengeance, are they not?
Yes. I'm sure if the Chinese are faced with a significant slowdown in the economy or a crash, as some people maintain, and these people are, in my opinion, rather well informed, then obviously the Chinese government will print money and rather let the currency go down. I mean, in India, the rupee has depreciated by 18% since July against the US dollar. Don't think, I mean, in general, in the long run, I'm also positive about emerging economies and about Asia and all that. But I think people should also realize there is a risk in economies that were a warrant on the Chinese economy that is driven largely by capital spending, because the capital spending cycle is, of course, much more volatile. That's why we call them cyclical industries. It's much more volatile than, say, consumption and in particular services.
We're talking to Marc Faber from the Gloom, Boom, and Doom Report. Mark, let's talk about gold for a second. Gold price is lower today after a nice rally last week. Everybody seems optimistic that European leaders are going to come up with some kind of plan. Is that going to affect gold? And what's your feeling about gold going forward?
My sense is that the easing measures in one form or the other by the ECB or the IMF or whoever does it, but it's certainly going to come, should be very gold positive. But you understand, the market is a discounting mechanism. And gold had a huge run to its September 21st high at $1,921. And I think we're still in a correction period. Now, what is the downside? I suppose from the peak to the low, it could be 40%. It's not a prediction. I'm just saying it can happen, and I'm always telling investors, don't buy gold on leverage, buy it for cash. And then you can endure the correction, and it would provide a tremendous additional buying opportunity. But I think my view is the S&P peaked out May 2nd of this year at 1,370. I don't think we will exceed that high before year end. And I don't think that the gold price will exceed $1,921 for the next 3 to 6 months.
I love this quote, Mark. I own my gold and I'll never sell it, especially when I see clowns like Ben Bernanke, Larry Summers, and Tim Geithner.
Correct. Overseas, the politicians are not much better.
Mark, we've got a few seconds left. Let's talk about Child's Dream and how you got involved with that.
Well, basically, Child's Dream is a charity that was formed by two ex-UBS bankers, 10 years ago or so. And they provide infrastructure for orphans in refugee camps around Asia. And they have a very low expense ratio, maybe just 8%. They get a lot of volunteers to come and help for them. And they essentially work without a salary, just the administration staff has to obviously be compensated in one form or the other. I mean, I've seen them and I know them, and I highly appreciate their integrity. I mean, I've been to many emerging economies. Wherever I am, I always see UN and other help organizations, people driving around the nicest cars. Mm-hmm. Usually Range Rovers.
Yes.
You understand? If you give to the Red Cross or to the UN and so forth, or UNESCO or whatever it is, most of it will go into administration. I'm not saying that they're doing a bad job, but by and large, the money doesn't flow down to the people on the ground. And I give you an example. I've been to Uganda. I've never seen so many NGOs as in Uganda. But the villages are all filthy dirty. So I ask myself, what do all these help organizations do? Where does the money go to? Why don't they teach people how to have self-reliant let's say, cleaning of the villages mm-hmm. and disposal of garbage. But no, not at all. In a way, I think the best is if you can do it yourself and help people in your surroundings. Now, not everybody has the time to mm-hmm. do that, but if you give money to charities, you should make sure it goes to people that really do something for others and don't live the high life on the contribution that they receive, either from governments or from the private sector.
You can find out more about Child's Dream at childsdream.org. Dr. Marc Faber publishes the Gloom, Boom, and Doom Report, Unusual Investment Opportunities Around the World, and he is online at gloomboomdoom.com. Dr. Marc Faber, thanks for this.
It's my pleasure.
Coming up.